It is called Peak 65. It's estimated that over 4 million people will reach 65 this year, ushering a new wave of retirements. And Nolan, I have to imagine you've probably been hit with this question a lot. Can I retire this year? What are some of the boxes you guys go through, some of the ones that you make sure are checked to help someone realize that they can, in fact, or perhaps can't retire here?
Well, if somebody's looking to really retire this year, I think that they want to do is avoid these 6 steps and follow these processes that we put in place. It's what we call the Retirement Team Action Plan. So within the Retirement Team Action Plan, we're talking about identifying where there's different threats and opportunities that is in their specific situation, things that can help them with better managing the money, protecting their assets, and efficiently planning their estate. And in addition to that, what we can do is we can pull the team in place on these different areas. So the 6 different steps, and if we look at them, number 1 is asking the question, do I have enough income to last the rest of my lifetime? So it's your income and your spending readiness. If you look at it, a simple way to do the math on this is what's called the 4% rule. The 4% rule is a rule that has been in the financial services industry for quite some time. And what it says is that, to determine the amount from an income and spending strategy, you could take a 4% withdrawal from your retirement accounts. So if you had $1 million saved up in financial retirement investments, withdrawing 4% would be $40,000 a year. If that covers your income spending needs, that's the simple rule. What we do here at America's Retirement Headquarters in that Retirement Team Action Plan is look at, the ways the simple rule could fail. As an example, there's what's called the sequence of return risk. And so for a retiree, the 4% rule may sound great, but if you retire right before the markets and the economy crash and you have a large percent of your money exposed to the stock market risk, it could put you in a situation where you're automatically upside down and significantly increase the chances of not having enough money to last forever. What we do is we will stress test your plan and we'll look at things like, well, what if tax rates go up? What if healthcare costs goes up? What if you have some type of need for long-term care? What if you live too long? What if somebody passes away too early? And by stress testing the plan, we can show where the strengths and weaknesses are and help you create that income and spending readiness in your plan. Number 2 is we're going to look at what investments should you live off of. You have essentially 3 buckets of money. You have your taxable bucket of money, you have your tax-deferred bucket of money, and you have your tax-free bucket of money. I'll give you a story of Ted. He came in here recently during our tax season time, met with retirement tax partners, and we did a what-if analysis. We looked at Ted and his wife's situation. And so Ted has recently retired in the past 2 years. And for the past 2 years, he's been saving and living off of his savings account and living off of the income that they collect from Social Security. So when we looked at his tax return, Ted and his wife didn't pay any federal taxes last year. Now, Chris, that might seem like a good thing, right? No federal income taxes you didn't pay.
I mean, it sounds pretty good, but I feel like there's probably a catch.
There is a catch. The catch is, in looking at it, he has the majority of his money invested in a tax-deferred retirement account. And so at the age of somewhere between 73 and 75, depending upon his age, he's going to be forced to take required minimum distributions out at some point in the future at whatever the tax rate is in the future. In addition to that, in 2024, every family, and even more so as you get older, you get some standard exemptions and deductions that you're able to take when filing your taxes. He really could have taken out, according to Retirement Tax Partner and the tax analysis that the CPA provided, he could have taken out roughly $30,000 out of retirement accounts and paid zero to little taxes on doing so. And by doing that, it would have allowed him to start getting money out of his retirement accounts, which could be a tax time bomb in the future, into a much more tax-efficient manner. So if you're looking at where do I take money from first, it can make a big difference. Another example that we're going to talk about is determining when you should take Social Security. Knowing what might be the best approach on when drawing Social Security can make a big difference. You can collect Social Security at age 62. You could take it at 66. You could take it and delay it until age 70. In my opinion, healthy married people may want to wait. And Social Security optimization, you get more income. In fact, delaying benefits from age 62 to age 70 for a married couple, you could ultimately end up getting more than 100% more income by waiting till later when you factor in the automatic increases plus cost of living increases. It can make a big, big difference. And Social Security can be more tax favorable in the long run. In those earlier years, you might be better off living off of your personal savings. Now, again, I say that with healthy married people. That is not always the case. If you're maybe somebody that is a single individual, maybe you have some health issues, in your situation, it could make sense if you wanted to take money early. In other situations, some people just need to take Social Security because they need that income. They don't have the luxury of taking money from other accounts. Fourth is you want to look, are you debt-free? With the hundreds of families that I work with, it is important to be debt-free because of reducing and eliminating the burden of what that cash flow is at retirement time.
Mm-hmm.
But it's a strategy to do so. I met with a couple that came into the office, and they said that in the previous year they had paid off their mortgage. I might say, hooray, that's a good idea. I think having your mortgage paid off is a good idea moving into retirement time. What they didn't realize, though, is that by taking a large withdrawal from their retirement accounts, it created an excess cost that they had for their Medicare premium. So they ended up paying a lot more money in healthcare costs because they didn't understand how to navigate being debt-free. They might have been better off paying off their mortgage over a 2 or 3 year time frame. But again, I would say that it's a good idea to be debt-free as you move into retirement time and avoid taking on big debts in retirement. I had somebody else that came into the office and they had come back from a trip that they went to one of these wonderful conferences, and they had an opportunity to do a timeshare presentation and probably get a free breakfast and some tickets to the water park. But the problem is now they have a $70,000 debt that they have in timeshares.
Yeah.
You don't take on those type of debts in moving into retirement time. You really want to be debt free. Number 5 is, do you understand your health care plan? Health insurance can be confusing. If you look at it, you've got pre-retirement, pre-65. You've got affordable health care. Do you get a short-term health care plan? Do you select COBRA? Is something offered through your company? Then at 65, you've got Medicare. Do you go and get a supplement? Do you take an Advantage plan? What are the gaps in coverages? How do you fill and cover those gaps? Looking at things like the issues of long-term care, what is Medicare going to cover if you or a loved one needs some type of long-term care, nursing home care, or those type of things that could wipe your family out if you didn't want to run out of money. And number 6 is looking at your estate and legal plans. Again, mistakes can be costly. 90% of the time I see estate plans that are not up to date. We'll have people that'll come into the office, and a lot of times I would say that they have developed a good plan. So they could say, yeah, we did our estate plans when our kids are little. Yes, we've saved up in a 401k. Yes, we've tried to eliminate most of the debts that we have, and generally we know some decisions that we're going to make. So they have a good plan. The process to really get you ready to retire is not missing those 6 steps. And it's a way to help take your retirement from good to great. And that's what we do right here at America's Retirement Headquarters. So to get the Retirement Team Action Plan, it's as easy as going over to the website, arhq.com. You can see it right at top there. You click on that Retirement Team Action Plan, schedule a time where one of our team members will walk you through these simple steps to get you to confident, not only get you to retirement, but to get you through retirement.
Perhaps over the course of the past 10 minutes or so, you've been listening to the steps that Nolan's laying out, and you said to yourself, I don't actually know the answers to those. And that is okay, because just by listening, you're showing that you're taking it seriously. The next step, have that retirement team action plan put together for you. You're either going to find out that you're on track. You're doing great, stay the course, and you're going to be able to retire on your own accord. Perhaps it is even this year. You may find out there is some work that needs to be done, which is something you probably don't want to hear, but now you'll know what the steps are to get closer and closer to that retirement that you've envisioned. That retirement team action plan, just a click away, arhq.com, or if you prefer, you can schedule a phone call as well, 419 794 3030.